Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Genscript Biotech Corporation, latest report. Genscript Biotech Corporation offers a diverse range of businesses and services across various industries. The company operates through three main segments: life science services and products, biologics development services, and industrial synthetic biology products. The Life Science Services and Products segment provides products and services in several categories, including gene synthesis, oligonucleotide synthesis, peptide synthesis, protein engineering, antibody development, and life science equipment and consumables. These products cater to various fields such as biology studies, pharmaceutical and drug discovery, disease diagnostics and vaccine, agriculture, environmental studies, and the food industry. The Biologics Development Services segment helps biopharmaceutical and biotech companies accelerate the development of therapeutic antibodies and gene/cell therapy products through an integrated platform. This service is designed to support the growth and success of these companies in their research and development endeavors. In addition to these services, Genscript also develops and produces industrial enzymes through non-pathogenic microbial strains constructed using genetic engineering. These enzymes are used in various industries, including agriculture, food processing, and pharmaceuticals. Overall, Genscript Biotech Corporation offers a comprehensive range of businesses and services that cater to the needs of life science research, biopharmaceutical development, and industrial applications. Genscript Biotech Corporation maintains a market capitalization of $28 billion, broadly in line with the industry peer group. Genscript Biotech Corporation trades at a lower price-to-book ratio of 0.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. While the company is able to service its interest expenses from operating income, the presence of recurring special charges raises concerns about underlying earnings quality. Investors should monitor whether these charges reflect ongoing operational inefficiencies. The primary drivers of revenue growth or decline in various industries can be attributed to several key factors. On the one hand, revenue growth is driven by shifts in customer preferences towards low-carbon products, development of sustainable products, and pressure on supply chains to reduce emissions. Improved production processes, transition to renewable energy sources, and expansion into markets with stricter carbon regulations also contribute to revenue growth. On the other hand, revenue decline is primarily driven by increased transparency requirements and stricter regulatory requirements for emissions reporting. This highlights the importance of adapting to changing customer needs and regulatory environments in order to remain competitive and achieve revenue growth. Management is emphasizing the importance of accelerating drug development through proprietary DNA synthesis technology and integrated platforms. This will be achieved by empowering innovation, delivering premium solutions, building collaborative ecosystems, upholding integrity, and exploring new opportunities in syn-bio products. The company also prioritizes environmental, social, and governance (ESG) management, aiming to develop an ESG vision, targets, strategy, and policies through the ESG working team. This includes improving governance, enabling clients, empowering employees, preserving the environment, and contributing to communities. Innovation and R&D are key drivers of progress for the company's clients and the broader scientific community. The company will advance next-generation gene-to-protein platforms through sustained R&D investments, continuously advancing technical capabilities and building sustainable core competitiveness. Management is also committed to upholding safety standards, with a proactive, prevention-oriented safety culture fostered through various initiatives. Additionally, the company prioritizes social responsibility, investing in social well-being and addressing shared challenges. The company believes that accelerating industry development is an important way to create value beyond its own operations, with partnerships playing a key role in driving innovation and promoting more responsible, inclusive, and scalable innovation. There are valid concerns about inventory buildup or supply chain disruption. The high concentration of suppliers in Asia, page 37, creates a risk of dependency on a single region, which can be exacerbated by sourcing strategies aimed at reducing risks, page 37. Furthermore, the sector-specific and commodity-specific risks are alarmingly high, with 68% and 15% respectively, indicating potential vulnerabilities in supply chains, page 39. The logistics and supply continuity have been interrupted, leading to delayed production schedules and distribution, page 65, which can lead to inventory buildup. Additionally, a significant amount of indirect emissions suggests that the current supply chain may be unsustainable and prone to disruptions, page 71. The increase in suppliers in Asia and decrease in Europe, page 98, also indicates shifting dynamics in global trade, which could impact supply chains. The data on increased downstream transportation and distribution by 478% and processing of sold products by 1882%, page 103, suggests a complex and potentially fragile supply chain. While the report repeatedly mentions no concerns, these statistics paint a different picture, indicating that there are indeed valid concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Genscript Biotech Corporation. Feel free to comment below, and I will be happy to answer them when possible.